Hello, Warriors. How's everyone doing today? My name's Dale. I have Didier and Brock and Ren, all your Warriors. Evening, Mark Williams. Turnaround Tuesday. Well, heck, gold sure turned around. All happening mainly in Europe. So we're down 7, but the acceleration. And you know what? I want to give Steve Volge. Said he wouldn't short it, but yesterday Steve was showing a chart where it was possible to have a shakeout to 1800. It's a coinkydink that the 50-day moving average, look how far it is above the 200, but that's where it came in, and that was 88.6 back before we made new all-time highs. So looking heavy. I don't know if I could buy this first break here. I'm very oversold, as you notice here. So those of you waiting for a break to buy gold, it's developing now. Same thing in silver. Silver's not down as hard on a percentage basis, but oh yeah, it's down harder, 4.5%. Although the chart, we didn't take out this low, last week's low yet. Where look at gold just, you know, took it out by a long shot. So a couple of things I'm looking at is a dollar better dig in its heels in here between here and 93. Um, for it to be an ascending triangle. I wouldn't want to see it closing back under this 93 level. Um, my choice for a dollar bounce now with the correlation that you can get in Aussie and gold is Aussie. May try 72, but this bounce could be a failing rally in Aussie and something that may be turning that. Hi, Gorkum. Uh, that would help for the Aussie to fail, and it's not doing it yet. But check out this candle that we're getting in Aussie Kiwi and the divergence. That's a 4-hour TF. That's a 2-hour. So divergences all over the place. This too could be a decent short. We get some type of reversal here. Um, I wonder what some of my associates are saying about this, the Aussie Kiwi. You guys want to see? Those of you that aren't subscribers, what you could get. So, I haven't taken a position there, but I'm very interested in it. I know Blake's active in the Aussie Kiwi. Huh, I know it's up here. There we go. Oh, looks like Greg is bullish. But okay, that's a big break from here to there. If we're topping up here, so he has it here at around 840, so we've extended it. Maybe it's going to be an irregular B. Irregular is where it takes out that high, but this is a daily, so we still did take out the high from May, I believe, in that. But see, this is all all at our fingertips. Let's see what Blake is saying here. It's Blake's chart. Okay. See what the takeaway is on it. Okay, still thinks it's pretty well bid, but neutral on it, as you can tell by the color. So something I'm seeing there, you know what? Looking at this, um, could be my turnaround Tuesday selection. Well, I'm showing Aussie Kiwi too. Okay. Because, when you're making a selection between like right now, look how much weaker Kiwi has been compared to Aussie. I mean, Aussie's been making new highs. Maybe you could see it better here. So look how much weaker Kiwi has been. It's underneath this stuff while the Aussie is in between. So this is something that could fail. I'm a little surprised. Oh, did I? As I got up late. So we'll see. I really think that if the dollar is going to stall at the euro, if the dollar is going to try and hold that double bottom, I don't think we want to see euro trading much above 118. Here, this bounce is acceptable. And of course, what else is happening? S&Ps are making new highs, but I keep pointing this out. S&Ps at new highs, and look at Nasdaq. What a glaring divergence. I know it's rotation, but these were the leaders, and they're sure acting poorly. They haven't made new highs. S&Ps have made successive new highs. So can we get one more push to a double top through this double top? I don't know. I think Nasdaq's really heavy in my view. Yen, not much of a pullback with the dollar weakening. Yen's still pretty stiff. Hard for me to get bearish here. Uh, Maybe we pull back again one more time, but again here, check out this 106.50 is going to be a breakout above this high. Okay, so if you are bearish, you have to get out of the way over 106.50. I'm constructive, and you guys know why I'm constructive. Is because I'm looking for higher yields, and that could be one of the reasons precious metals is down, is that the market is smelling higher yields coming. Here's your 10-year. So we went down to 50. We're already up to 60. I've noticed a few people, our guest yesterday, felt that we could head up towards 120 in the yield. So, that's not going to be constructive for gold. Eventually, I don't think for the market when it's figured into valuations. Here's the 30-year, same type of thing. This is a second higher low. So here's your first higher low, and then we pulled back. So actually, bonds yields look stickier than the 10-year, and they have for a while. So that's why some of the financials are doing pretty good. So there's that, and here's TLT. Put in a pretty lousy day. Looks like it's rolling over. So that mantra, lower for longer. And I'm not thinking about thinking about thinking about thinking about raising rates, Jerome Powell. Well, it doesn't seem like the market cares what he's thinking about or not thinking about. And it looks like yields could make a move back to the upside. Eventually here, and why not here? And if long bond maturities get back under this low, so, didn't kill the market when we did this, and, I was there for this. Why can't we have it happen again? All right. So, be careful about adopting universal maxims like that. Lower for longer. Okay. You know, lower for longer, or maybe yields will be stronger. Hello, Blake Morrow. How are you, buddy? I'm
Hey, good
curious.
morning, Dale.
I'm curious. I know you had a little bit of a bias that Euro looked heavy. I'm wondering if this pop that we're getting here changes your technical view and what levels, if any, you would consider shorting
Wait,
Euro.
are you I'm sorry. I got to turn up the volume here. I couldn't
Okay,
hear you very well.
that's
Hold
okay,
on really
buddy.
quick. Okay, what'd you say?
Well, I'm just curious. I yesterday when you were showing the euro, you thought that there was a potential of a correction that might begin to the downside, and we have a little pop here. I'm wondering if this pop
Y-
in euro changes your technical view. Just curious about what you're thinking here with this bounce here in euro after a couple of down days.
You know, that's a good question. First of all, I think that yesterday we were talking about the euro continuing, lower, and let me pull up the chart here. And we continue to drift lower in the euro, and we actually hit 117.20 overnight. So in
Okay.
Asian trade, we just continued lower. So yesterday we were trading about
Yeah.
right about where we're at right now, and we continued
Right.
lower, and we came really close to the 117, which I think is really key support. We have bounced, and the bounce has lasted all the way to the 38% retracement. You can see right here at 117.96. We actually overshot it, maybe even give us a little false breakout. And now, we're still trading pretty heavy. I know, some of you might be looking at the euro saying, what are you talking about, Blake? Trading heavy. It's up on the day. It is up on the day, but it's not really. I mean, it's up. The dollar is weaker. The euro is stronger, but you know, it really has only bounced to a
Yeah.
38% retracement of its fall. So, am I still bearish the euro? Do I think the euro can go lower? I still do. There's a chart that I want to show you that was passed along to me. This is the 10-year. It's the 10-year real rates, and we've seen a bounce in yield, basically moving higher. And this is, in my opinion, a bit of a warning for dollar bears. If you're a dollar bear, you've been seeing the real yield, real rates moving lower consistently I mean, look at all of June and all of July, right? We're seeing that bounce now, and that could actually translate into a dollar bounce as well. So I wouldn't get too terribly carried away with dollar um,
Yeah.
shorts at this point.
Sure.
Okay. So anyway, just and that those
Okay.
those are my initial thoughts, Dale.
That's a cold chart, Blake. So we've been negative rates. No wonder precious metals have been rolling. It's not
Yeah,
even
and now and that on top of that, yeah, and that's a good point, Dale. Is you've seen a pullback in gold to really important support here. We
yeah,
broke through 2000, we broke through 1180.
yeah,
I mean, we're right now we're at the 618 retracement. We're just about at the 618 retracement. I mean, there's a risk of gold actually pulling back quite aggressively. When I say quite aggressively, I mean we could really pull back towards that 1920 level. And so what does that do to the dollar? I mean, if gold continues to pull back toward, or 1920 is the big, here it's this blue
yeah.
area here. Let me pull up a monthly
Steve
chart.
was
Just
showing 1800 yesterday as being a possibility, and that's really where it started to accelerate.
well,
One
damn it.
step at a time, but yeah,
Yeah. I mean, I try, I try to look like a day ahead.
yeah, I
It's,
know. Yeah,
it's in
he
this
was
in
being
this environment. It's
Nostradamus.
hard to see much further than that. It seems like, but anyway, but this is really the breakout point, the multi-year breakout point. I mean, and the all-time high was around the
Oh yeah,
1920 level.
right.
So if gold continues to drift lower over the course of the next couple of days, that could very well give the dollar a boost. So I would be very careful being too short dollars at this point. You got to look at other currencies too, and then I got to get to the bias chart here. You know, the cables had a decent bounce. Cable's still holding up pretty well. Actually, it's probably holding up the best. The Aussie, you know, kind of a lackluster bounce. I mean, we're at levels that we were at, you know, yesterday too. I mean, not, you know, we're not anything, you know, that's screaming, oh my God, Aussie's breaking out. Kiwi's trading heavy, and this is ahead of the RBNZ tonight. So, you know, again, I'm I'd be a little careful being short dollars up here or down here. Is what I meant to say. So let me go ahead and get the bias chart done so I can.
Go and make money.
Well, yeah, I want to be able to get all this stuff ready for you
Okay.
guys. So, and that too. Unfortunately, I got a meeting, but that's not going to help things.
I'm going to mute myself so I don't interrupt you.
All right, thank you. So here's the euro. I know we've you know rallied to 118.08. I would think that 118.20, the 50% retracement, should offer pretty good resistance. Whoops, I didn't want to do that. 118.20. Now I do think the euro is still bullish. You know, and that's that. Again, I have to say that every day that I think the euro's in a bullish breakout and we're in a bullish trend. That doesn't mean that it's going to move up every day. Just because it's, you just have to realize that if you're trading counter trend, like let's say you go, oh, you know, Blake, you know, you're just saying the dollar may bounce, but the euro's bullish. Yeah, if you decide to short the euro, just take smaller positions because it is in a bullish trend. You have to realize that the euro is, you know, I mean, this is a very, very strong move, and you know, quite frankly, while we're above 116, I can't be like bearish, you know, like outright bearish. But right now, I do think that the euro is at risk of correcting and maybe even, you know, breaking below 117. I think 117 is key support for this bullish trend right now. Okay, so I'm going to put an asterisk there as being key. The cable is still holding up very well. We are around the 618 retracement. This Nidish from our chat room brought up this trend line yesterday from these highs here, and I had it deleted for a while, but it's, you know, it's a good reminder that that's really capping the rally. That comes in at, you know, currently about 131.85, which, you know, the recent highs are up here. So I'm just going to write down 131.85. 131.85 is still key resistance. But we might actually, I was going to say we might find resistance ahead of that, but I'm just more concerned with, you know, rallies up to there. Support right now is at 130. It seems like 130 dips are holding. So, okay. Aussie. Now, like I mentioned, the Aussie, I mean, we're at levels that we saw yesterday, and we're not much above that. And it's a 38% retracement if you haven't seen it. Whoops. So 30% retracement, 50% retracement, previous support that should act as resistance. That comes in at 71.90, say roughly 71.95 is resistance. It's still bullish while we're above that 70.75. But we have other support here, which comes in at 71.40, which, by the way, let's just take a real quick look. That is the 618. That's why it's important, 71.40. And it's still bullish, just, you know, we've got some, you know, support levels ahead of here that we just need to be aware of. And just realize that the Aussies bit struggling. And even with stocks, I mean, you look at the stock market's, I mean, the S&P continues to break out. You know, the Dow continues to break higher. And by the way, this is rotation. As you see, NASDAQ moving lower, Dow's going higher. That's just simple rotation. And while that's happening, you know, you gotta just you gotta keep in mind that that's going to keep the dollar pretty well contained. You're not going to see the dollar really rally substantially while there's rotation. If there's, you know, some strong equity market selling, then that might be a different story. Sorry, I was just getting a drink of my coffee here. Kiwi. Now, as you guys know, and I've talked a lot about this really important support at 65.75, 65.80. This is really important support. I'm putting multiple asterisks there. I'm going to keep it on range. We have the RBNZ tonight, and the market's expecting a dovish RBNZ, you know, a dovish central bank, but you know, the risk is that you don't get it, and if that happens, then the Kiwi is going to bounce from here. And I would also say that from a risk reward perspective, this is probably a good place to be on the long side of the Kiwi. You know, your risk is below 65.70, right? So you're only risking about 40 pips. But I do have to point out that the Kiwi is really the rally has been very lackluster, you know, recently, and that's you know, anybody who's long the Kiwi is probably thinking about that pretty much. So resistance right now is 66. 50% retracement right here is going to be 66.30. And the only reason why I'm going to leave this as range, because it is really underperforming right now. It really is, and that's something that we just have to take note of. Dollar Canadian trading very heavy. I can't get out of my mind that we had a false breakdown last week, but we are under pressure as crude oil is strong. I mean, crude's strong with stocks right now. So the 78% retracement should offer some support, but I am going to write down 132.33. And this is my chart of the day yesterday, and I'm going to keep it on range, but it is trading heavy today. And bottom line is 134 is just key resistance. That's channel resistance right there. So 134, no if and or buts. This is really big. And, you know, until we get above that level, it won't turn bullish. All right. We have to get above that channel resistance. And until then, it's going to, you know, it's trading heavy. NASDAQ, NASDAQ's near its lows of the session. Just a little heads up. Dollar Mexican peso, big support here at 22.30. You know, just we've been holding it pretty well. We're basically sitting on it now. 618 comes in at 22.25. So I'm going to write that down. Resistance is 22.60. It's really the same. It's in range right now. Dollar Swiss, or I'm sorry, I'm trying to go down this direction. Let's go over to the Swissy. So Swissy, key support at 90.54, resistance is at 92.40, and that's it. You know, we had a nice little up channel, and then just, you know, slumped. So anyway, yeah, I think I'm gonna have to write down 90.50 and 92.40 and just leave it alone. My focus has not been on the Swissy recently anyway. 92.40, and this is bearish, obviously. And frankly, as long as the Swissy is below this 92.40, and you know, this dotted trend line, that's a multi-year trend line here. While we're below that trend line, it is bearish. The peso is under a little bit of pressure. We should drop to the 22.25 level here shortly. We might get to that 618 as we push through that support. US dollar, Norwegian krona. Let's see, 890 is support. Whoops. And this still remains. Resistance over here is 908. It's still bearish well below that daily trend line, right? This is a big daily trend line here. That is bearish. Okay. Let's see here. Dollar yen. Channel resistance comes in, and I mean this resistance is really 106.50, but that the channel is at 106.35, but we do need to get above 106.50 to to really turn bullish here. 106.50 and 105.30 I believe is the support. Yeah, 105.30, same as yesterday. Okay. Dollar index. Let's talk about the Dixie. So remember, we've been monitoring this this possible double bottom, but we have to get above 94. So 92.50, 94, it's still bearish. So 92.50, 94 is key resistance, and it's still bearish while we're below 94. But if we get above 94, then you should get a little bit of a squeeze. Gold. Let's talk about gold. So gold is still bullish. I know it's come off today quite a bit. And you're like, wow, how's it bullish? We've come up, but remember, we're at all-time highs. I mean, we've come off a little bit, but really, I mean, the 618 retracement comes in at 1970. So I'm going to write that down as intraday support. So we got 1920. Whoops. 1920. Obviously, that's key. What did I say? 1970. 1970. And then resistance now, I guess resistance on any rally. Whoops, that's not what I wanted. Let's get rid of that. I don't need that now. Resistance on any rally back to here, which would be 2010 is resistance. Okay. Let's go over to the S&P. And by the way, do we have data coming out, guys? Stelio, Steve, good morning, guys. Do we have data coming out?
Hello. Not that actually, we do have PPI. Yeah, US PPI.
We do have, okay, PPI. Or no, we have CPI.
No,
we got to pay attention to that. Okay, here's the S&P. All-time highs, we are just really close to it. So that all-time high comes in at basically 3,400, right? And support right now is 3,300, and it's bullish. So, and 3,400, which is basically all-time highs, and we're bullish. So good morning, guys. How are you?
I'm very well. Good morning.
Good morning. Steve, good morning.
Good morning.
So we have the NASDAQ showing some weakness. We have the S&P continuing to be bullish here. What do you guys make of this move that we're seeing?
I think the S&P needs to see a new all-time high before it can retreat. Just my
before
feeling.
What?
Before it retreats lower. I think
okay. Well, that very well could happen today. And by the way, volatility is. Yeah, I just wanted to point this out really quick, and we'll pull up the euro as these numbers come out. Volatility is VIX is like around 21, but the DSI on VIX was
it 8?
8, so it's very extreme. I think the risk of us, hitting new highs in the S&P and quite possibly reversing at those highs, I think it is a risk today, especially with volatility at such extreme levels. If it's not today, it'll be tomorrow. So I think within the next couple of days, we can see, that happen.
Stelios has been saying new highs for several hundred handles.
He has,
So,
he has, and you
It's
know what,
several hundred
and
years.
I have to hand it to Steve. Steve called the bottom at the bottom. So
Here we go. PPI better than expected.
okay, so a little bit better than expected. The dollar is, let's see what the dollar is doing, because the euro is just kind of sitting there, but the dollar is, I guess, firming up just a bit, but nothing exciting here. But look at matter of fact, look at yields. And I know I was pulling up real rates earlier, but look at yields and look what they're doing right now. Here's the 10-year. Look at the 5-minute chart on the 10-year yield. So what do you make of this move in bonds, guys?
Good question. Actually, if you put it in perspective, it's like 4 basis points, so it's not it's not the end of the world either way. Although it does look spectacular on the chart. I don't know. Is it on the back of Putin's vaccine or whatever? Who knows? It's
it's a combination of factors. Theoretically, it's the market is cheering today because more news of a vaccine. So theoretically speaking, like more hopes that the whole COVID story can come to a close sooner rather than later, and of course, hopes that the new round of stimulus is around the corner. So of course, for whoever understands how economies work, new round of stimulus would be long-term bearish, of course, the dollar, but nobody anymore trades, based on that. And we're still living in the rather recent La La Land story that deficits don't matter, debt doesn't matter. The only thing that matters is to stimulate nominal GDP growth, and everything else can go to hell, and it's somebody else's problem in the future.
So do you think that this move in yields is going to translate to a bounce in the dollar? Because I think it will, especially if you've been watching, like let's just go over to the 10-year, the 10-year bond market, and you can see how we had this nice little rally into towards all-time highs. Now we're reversing, and frankly, if we get a move below this support here in the 10-year, that means yields are really going to start to bounce. And if that does happen, I think that should translate into a dollar bounce story, if not a short-term dollar rally story. So
yes, that's a valid perspective, Blake. Although just to have the full picture in mind, two things we have to keep in mind. First of all, we had a huge divergence between yield differentials, for example, for a long period of time before it could actually. I remember us speaking on this webinar about it several. I would say a couple of months ago, at least, when we were showing the yield differentials, which would imply that either yields should close the gap or Euro USD should rebound a long time ago.
You're talking about the yield differential between the notes and the bonds?
Yes, which
bonds,
finally were bridged, but after a long period of time with this move higher in the euro. Nobody says that this can happen again. In what sense? I mean, nobody says that the dollar has to immediately react. Plus, there is the fact that real yields is what matters, which they are also rebounding, as you very well showed. But so far, I mean, this downtrend remains. Small rebound in the dollar. Yeah, I mean, absolutely, it can happen. Although I still see evidence only of a consolidation. I mean, we need to see more to really break out in a sense and reverse this trend. I think it's quite tricky because the market is really running behind its tail in many aspects, and uncertainties still remain extremely high, and the US still remains the one that seems to be more willing to press the monetary stimulus side. So let's see.
All right. Well, thanks for your insights, guys. I'm going to pass it over to you. For those of you that have not checked out Pepperstone Securities, make sure you do so. They are one of our webinar sponsors, alongside with Forest Park FX. So if you're outside of the U.S. and Canada, make sure you look at Pepperstone Securities, and this way you could possibly get Forex Analytics for free for a certain period of time. And you can find that in our Forex sponsored tab on our website. You can find out all the details there. So, guys, thank you so much for listening in to me. Stick around for Steve Stelios and Coach, and I'm sure Dale's got a great interview lined up today. I've got to run. You guys have a great one. Thank you so much.
Thank you, Blaker.
All right.
Thank you,
Good
Blake.
hunting, Blake.
Thanks,
Thank you,
guys.
Blake.
Good luck.
Hello, guys.
Hey,
All
Sal.
good. All
Hey,
good
Stel.
today. Yeah. So, a couple of things to cover. First of all, Mr. Putin apparently has got the vaccine. He actually said he's tested it on one of his daughters.
The one he likes the
less.
least, I'm assuming. Yeah.
Yeah, but so this is another
She must
sign.
have been a really bad girl or something.
Yeah, so this is another sign from another country. We've had UK, Israel, China, US. I think now Russia is joining them. That is very promising on a vaccine. I hope it materializes, and I hope that we have it on time for next winter, because really this winter is out of the question. But the market, as always, likes good news and is cheering higher along with that. On the other side, on the bad news, we had in New Zealand, we had the first cases of COVID after over 100 days of no cases. It's only a handful, but they've moved very fast from what I'm reading, and they're closing down. I think they're putting Auckland they're shutting down Auckland basically, which is probably the right thing to do. Anyways, but it's showing that even in places where theoretically they were clean, and these people, from what I read, they had zero interaction from with outside other countries. Somehow they are positive. So another thing to note, and another thing to keep in mind, that there's a lot of countries that either are returning to more cases or are increasing at a rapid pace, and Greece is one of them, unfortunately. And the other thing, again, on the bad news side, is that the Republicans and Democrats have not agreed on anything yet in terms of another stimulus package. And Donald Trump is trying to do his best with executive orders to kind of bridge the gap. So he said yesterday that he's very seriously considering cutting capital gains tax rate. This is something he cannot do on his own. He needs Congress, but
Theoretically, he needs Congress for the rest of the executive orders he also issued.
Yes.
It's a whole cat and mouse game. It's like, okay, I know at least 3 of them are most probably unconstitutional, but it's all about, okay, who's going to go against them, because you know how it is. It's pre-season.
Yeah, exactly. That's the right word, actually.
Yeah, ahead of the elections. So there is a good spin about it. If the Democrats try to fight against the legality of these orders, they're going to be painted as the ones that are trying to take away stimulus money from the citizens.
Yeah.
So it's in essence, it's a chess game here.
He also said, guys, that if he's not reelected, the markets will crash and everyone's 401ks will be worthless. He came out and said that yesterday.
He's probably right that the market will go down. But yeah, it's
China will own us. A lot of fear.
Yeah.
If you don't reelect me, you're going to be broke.
Well, yeah, he has to make
more broke.
Yeah, well, not the country, but
right.
people that have had recoveries with their 401ks, with their portfolios.
Yeah, but still, that's unfortunately not a majority of the population. Is actually a minority, as you very well said.
Right.
Yeah. So data-wise, we have the RBNZ later tonight, if I recall. Yes, and this new COVID issue there might influence them. I don't know, but we're going to have to see. We had data out of the UK, earnings and unemployment. unemployment ticked down, average earnings ticked down as well. So, kind of neutral overall. And in Europe, in Germany, we had the ZEW, which again, I posted this on chatroom earlier. It shows the current state of mind of markets. Current conditions are a lot worse than expected, but hey, economic sentiment, a lot better. So things are really bad, but they're going to get a lot better very quickly. Yes.
Did you say they shut down Oakland still?
Auckland in New Zealand.
In New Zealand.
Okay.
And that's because they got 4 confirmed cases after 100 days of 0 cases.
Well, you have to give it to their government. They are active. They take initiative.
Yes.
But anyway, is it the right thing or the wrong thing to do? That's a big discussion. I think it's the right thing to do. But as I said, so that's it data-wise. Another thing, just to briefly touch upon, precious metals. For people who have been on the chat room who are Forex Analytics subscribers, I was saying on Monday, look, Friday's candle, the close was not good. The long wick above, and I did say I think we're at at the top here. Obviously not a long-term top, but a short-term top for sure. That's why I had been taking off my long silver position. I still have a quarter on just for how should I say it, from principle. I never want to be completely flat, especially from levels which are not, which don't look like they're a bubble. If we get to 50s and again, then obviously I'm going to rethink that. But you can see precious metals falling today. Gold below 2000.
The short-term trend is broken here. Stelio, there is no question about it. We're even slicing through this first area of support at 1980, 1983. This little zone there, inevitably it would happen. I mean, when we broke through that area, I was targeting, this is what I drew, like another attack higher, perhaps towards 2111, before seeing a deeper correction, a much deeper correction, which we hadn't seen for a long period of time. We never made it there. We went, almost there, like 3/4 on the way from there to 2111. Clearly the trend has now been broken. There is a lot to be said. Blake spoke about the jump in real yields, which is what's driving gold. There's no question about it. Do I think that this move higher in real yields is there to stay? That's the beginning of a big move higher in real yields. Don't confuse that with nominal yields. I think absolutely not. So I think this is going to be a short-lived move. It can prove to be a sharp correction lower. We warned multiple times about it. When you have such a huge move higher, a corrective move can be sharp, can be quite brutal, can confuse a lot of people that are inclined to believe that gold should not be up here, and it's mispriced to think that this is a beginning like of a huge move to the downside. I think they're going to find themselves being on the wrong side once again, because I do believe that all the fundamental reasons that are fueling the move in gold are still there. Nothing moves in an absolute straight line. Everybody that has been in the markets even for a few months knows that. And I do think that we'll find support sooner rather than later and see another leg to the upside.
I agree. I think if we get anywhere near 1800, that would be a great opportunity.
Yeah, we have 1820 as one zone of interest, 1750, and gold can actually retrace even that much. It can even do it rather quickly, but I do believe that there is going to be a lot of demand jumping in the market if we get anywhere close to that. There's going to be a lot of people that were out of this move, that were caught off guard from this move, and really want to be owning as part of their portfolios at least some gold for protection, that they're going to be loading up the boat down there.
I agree, and I think silver, if we do get anywhere near $21, I mean, that would be a gift to get long again.
Oh yeah.
And silver can move a lot. We've seen that. It can move a lot more than gold, that's for sure. So why not?
And we know that historically there is a good chance, if there is a period now of corrective moves for the two precious metals, we know that it's very likely that silver will now underperform gold because usually the gold-silver ratio is doing better when they're moving higher, and it's doing worse when they're moving higher, and it's doing better when they're actually moving lower. So might also be quite a nice opportunity for a very, very overdone gold-silver ratio to finally get, some type of a relief rally. I mean, we went all the way from 129.3 to below 70 within, what is it, like 4 months, whatever it is, 5 months. So it's long overdue. I think it can happen at the same time.
Absolutely.
80 is an interesting area of resistance, by the way, in the gold-silver ratio.
Yeah, and I think this will probably manifest itself when the S&P reaches new all-time highs. Stops get triggered, everybody gets long, and then we get. I don't know what the trigger is going to be. I think we're going to get a leg lower, and that will bring the gold-silver ratio higher and silver lower, hopefully towards 21. So
yeah, I mean that would be nice. Is it going to happen? I don't know, but you're talking about these highs over there, right?
Yes.
Yeah. It's the first area of interest. We can actually mark it down there. Yeah, so it is the first area of interest. Below that we have 19, but I very much doubt we can be that lucky and get an opportunity to buy again at 19. I mean, that would be more than a gift, actually.
Yeah.
Okay. Do we have anything else, Stel?
No, that's it. And data-wise, we're done for the day. So.
Yeah. So there is a good chance that the early day momentum is going to resume for the rest of the day. So starting from the DXY index, because this remains rather a key for the FX markets. As we've been saying, there was always the potential of some type of rebound in the DXY, and at some point it's going to happen. But we said it multiple times since last week. In order for anybody to start talking about a technical move worth noting here, we do need to see a break above 94, because that and only that will trigger this small rectangle formation that you want to call it a double bottom. Doesn't really matter because the implied target is going to be the same, a move towards 95.5. As long as we trade below 94, there is still a good chance that this is just a bearish consolidation, and bearish in the sense that we entered this consolidation following a rather strong move lower. So before we get really enthusiastic about dollar breaking higher, we do need to see the DXY taking out the 94 area of resistance. Until that happens, we are in we are in the vicinity of just making assumption what's going to happen if and what's going to happen when. For example, yesterday we spoke about, let me bring the 4-hour chart here. We spoke about the euro. I said that, listen, very similarly to the DXY, if you want to see, if you want to talk about a breakdown in the euro, you do need to see a move below 117, to take out these lows and actually trigger a double top in the euro. That didn't happen. We actually found support a little bit higher than 117, and we seem to be rebounding today. Of course, that doesn't mean that we're resuming to the upside, but that means that since we haven't broken down yet, at the very least, if you want to be cautious, you have to be neutral here. There is a chance that this is going to be another bullish consolidation in the Euro USD, and we will need to see one more move higher towards the target we spoke last week about, which was the 120, close to 120.50, the 161.8% extension of this move lower. It's more or less the same target. We have the 161.8% fib from this move lower, coming up at 120.25. So between 120 25 and 120 like 40, whatever that was. We have two fib extensions that look rather interesting. So perhaps it's still likely that the euro might seek another move to the upside. I've seen a lot of people turning bearish. We talked about the possibility, of course, of euro turning bearish for a corrective move, and at some point it's going to happen, but we don't have, concrete evidence that it has started yet. Don't forget that, um, uh, irrespective of if we've already started on Friday and move lower, and we're just consolidating now before we actually accelerate to the downside, or if we actually need to do that from a little bit higher. What remains the case is that I think more or less all of us here agree that whenever this corrective move lower comes, it's going to be a buying opportunity. So bottom line, if you're looking to be in the right direction of the market, I think that, and you want to be conservative, I think the best thing you can do is wait for the opportunity to buy lower. That might as well come after seeing higher prices. And, I have nothing really different to say in regards to, for example, the pound. The pound's still holding up here. Momentum has clearly waned, but that doesn't mean that we can't reach the confluence of resistances at 132.50 first before we actually see a deeper correction lower. Aussie had quite a nice negative day on Friday, toying around with this long-term trend line resistance once again. Hasn't broken down yet. On the other hand, risk reward in buying it doesn't make much sense. So another market you'd rather be a little bit careful. Silver is taking it on the chin as we speak, by the way. Silver is now more than 6.5% lower in the day. I think that this market has now broken, and I'm only referring to the short term, of course, right? I do think that there is going to be we're going to be seeing now quite a violent move. That's probably going to be a combination of a lot of the people that were still holding long positions that are thinking, okay, I'd rather now take some profits, and some of the people that foolishly tried to jump long very, very late in these moves. And many of them, will end up holding the bag. Most of them are going to be the type of people that are actually, once silver and gold turn higher once again, they're going to be out of their positions. They will have already lost money being long because they were long at the totally different, at the totally wrong price, with a totally stupid risk reward, and they won't be buying again when the risk reward will be making sense. So a few more days of downside move is definitely extremely likely. And as I said, a good opportunity for the gold-silver ratio to actually rebound. Palladium, platinum, as you can see, both taking it on the chin as well. Here they are. Keep in mind, though, nothing really changes. 875 is a key level for platinum. We're far away from that. Palladium, we already talked about it likely being in this long-term symmetrical triangle. Still, no developments here. We're actually exactly in the middle of it, so not much to see here. Copper still consolidating, definitely not broken down. I mean, you can see this ascending channel holding up, quite nicely. Crude oil kind of celebrating this risk on mood with another day of, this slow drift higher. We've talked, many times about how this move can possibly get resolved. I still think there is a good chance that we're going to see like a jump higher from this ascending triangle. It's going to be very short-lived before we see a sharp corrective move lower. So I think that chasing crude oil higher at current prices was as smart as it would be for somebody that had no exposure previously to be buying like gold at 2050, to be buying like silver at 29. I mean, yeah, you were in the direction of the trend, but after the train had already left the station like long time ago, you decided to jump on the last wagon, and that was probably a bad idea. I think with some type of a lag, probably we're seeing the same type of situation here with crude oil. It's not that overdone, so in that sense, not comparing them having to do with prior momentum, but I do think that from the move lower in when we found a low at $11, and I'm talking about the continuous now, to where we've already found ourselves, at 42 and a half. I think that there needs to be some type of a corrective move lower, and be it from here, be it from a little bit higher. I think it's coming sooner rather than later. Now, nothing really to talk about having to do with stock markets because nothing has really changed. We had talked about the possibility of getting one last move, exactly the type of move I was just describing, potentially for crude oil. Seeing this type of a move happening here in the S&P. We've already been trading for 4 days, 3.5 days above this ascending triangle. Still, the area between 3,400 and 3,417 remains an appealing one. We are seeing some type of a rotation, from the tech momentum stocks into the S&P and Dow. Have a look at the Dow yesterday. And that's an indication actually that the market participants somehow believe that the outlook for the future might have improved somewhat, because one of the reasons they were jumping on so overvalued tech stocks is because they were considering them safe haven, in case of another lockdown. I mean, companies like Netflix, like Amazon, theoretically, totally protected from any downside in the sense that they benefit from people getting locked down. Of course, in the long term, that's not even true. It's only in the short term because long-term repercussions of lockdowns are negative for the economy, and negative for the economy means less buying, everywhere. So people might not cut on the basic groceries, but like buying, expensive devices through Amazon or other stuff that are not necessary. Any type of discretionary spending is going to be eventually hit. And people that believe that governments can keep sending $1,000, $2,000 gifts per month just because the economic situation is bad, and that can continue indefinitely, don't really understand how this thing works. I have no doubt that they would like to be doing that, but eventually the market is going to force them to realize that they can't do that, and the only forcing mechanism that the market has is the value of the dollar, and sooner rather than later they will have to face the consequences of what that means, and then they will have to take a different route. For the time being, though, it's the status quo, and trading short term doesn't really mean that you should take any of that into account. If you want to be trading, on a daily, in intraday or like for a few days per time, none of that really matters for any of your trades specifically. Now let me go through some of your questions. A very little time we have. IWM, yeah, IWM. Here it is. The IWM has broken through this symmetrical triangle, at the same time finding support once again in this ascending channel. It has now retraced more than 80% of this move lower. I remind you that the IWM was the actually only index that was diverging prior to the move, to the sharp move lower that we had due to COVID. I mean, it was the only one that hadn't actually produced a higher high. Of course, that still remains the case. But in the short term, it looks fine. I assume we need a little bit more to fulfill the target of this symmetrical triangle. Next upside resistance at 162. Upside targets are 3470 and 3790. Yeah, I mean, a lot of upside targets in the S&P. There is no question that the trend is higher. Um, you know, we have to take it one day at a time. I do think, though, that before any of these targets that you mentioned are hit, for example, 37.27 is the 127% extension of this COVID move lower. I do think that the market will have to produce some type of a corrective move lower. So I don't think we're going to 37.27 like in a straight line, or with, the type of minimum pullbacks that we've seen so far. Valuations are already, more than excessive. And the market quite one-sided at the moment. I do think that as gold and silver are doing as we speak, there is going to be some shaking off the weak hands before this market can continue higher. And of course, inflation will keep pushing this market higher. Inflation, of course, with the traditional, definition of inflation, which is the expansion of money and credit. Personally, would prefer to see this market crash as it's priced to perfection. No, it's not priced to perfection. We're way past priced to perfection. It was priced to perfection pre-COVID. Now it's priced for more than that, but I don't know if there's a word that can describe it accurately. 3-year note auction today, says Joe. Our Joe, isn't the Fed targeting the 3-year? Maybe somebody selling far end to buy short term. Okay, yeah, would make sense. Apparently, there seems to be some. See, Dale, if your guest is here, just let me know, right?
Okay, Alex Mystery, can you let
We
me
have some
know
people.
what you're registered under?
We have some people asking about natural gas. So here's natural gas.
Send me
Natural
something in
gas.
chat. That was a
Natural.
great call by you, Steve.
Thank you, Dale. Although, as I said, I'd rather buy gold and silver lower than, be short. So natural gas consolidating.
Natural gas was what I was talking about.
Yeah. Okay. So
there he is. Okay.
Consolidating its recent gains, as I've said before, as long as we trade above $2 to 205, I think there is, no real change here in the technical perspective. We can still see a move towards 2.5 to 2.6 to fulfill the upside target. Okay, Dale.
Right,
so why
buddy.
don't you promote your guest?
Okay, going to do it now. Welcome back to Face. Mystery Trader 99.
Let's see.
Waiting
There
to hear
he
you,
is.
bro.
We heard him, actually.
Hello. Let's see.
You're really being a mystery today.
Are you there? Can you hear me?
Yep.
Oh, we've solved the mystery.
Perfect. And then do you start video?
No. Well,
Yeah,
if you
we
want
can
to
see
see
your
your
screen.
face, if you want to.
No. Is it? Can you see my screen?
Yeah, possible catalysts.
Okay.
You
Cool.
prepare. You have a whole PowerPoint here, buddy. I appreciate all the preparation you go through every time you're here, and looking forward to an update on your global forex parity.
I appreciate it, Dale. Thank you so much for having me again. I'm glad to be back with you. It's been quite a crazy couple months we've had.
Well, you know what? I want to acknowledge on your last interview, I think you were talking about 2,200 gold by next spring. Almost got there in a hurry.
Yeah, it was the original call was 2,100 by the end of 2021, but my secret number was I'll go and give you my exact number here, Target, in a second.
Of course it would be a secret, but anyway, it was a good call. You weren't bearish. You were looking for higher numbers. Nice call.
I appreciate it. And I'll kind of go through for those of you who weren't on part, I didn't watch 1 through 3, and we'll put the links in the description. But basically, we'll go over what happened, what we talked about in part 3, some of the things we discussed, some things that did happen, some things that did not, and then we'll kind of move on to some of the Forex updates. We'll kind of go over bonds for a bit. gold, and then kind of tie everything in together at the end. But thanks again, Dale, for having me on. It's been quite an eventful few months. It's amazing how fast these markets are moving these days. But initially, when we were on last time, we discussed how, almost perfectly, you always invite me on at the perfect time when big moves are about to happen. Literally, as we were just discussing that morning, the move to my initial target of 1142 on the euro dollar happened, and then from there, kind of a second impulse up to my upper blue trend line on the macro charts. So that happened. Great British Pound would show relative weakness towards the euro. The dollar would then consolidate down to its lower 10-year trend line support. The Fed would obviously, pump stimulus. At that time, the dollar index was around 99. Obviously, it's come off a lot since then. In just 2 months.
Yes.
It's crazy to believe.
Yes.
So that came off down to my 10-year trend line. Fed would, be pumping a lot of money and stimulus into the system, which would put further downward pressure on the U.S. dollar. Treasury yields would have one more drop before a final bottom would occur. The Treasury yields would remain depressed. And also that gold would hit 2,100 before the end of 2021. That was obviously conservative. Now we hit 2,089. So I was off by $11. I don't know if you want to give me that $11 or not, but we're almost there. And then I kind of discussed last time how treasury demand would actually start overflowing into gold. And now we're starting to see a lot of that over the past 2 months kind of creep into the system, how gold was relatively cheap on a historical basis. And then also based on gold DXY pairs and gold TLT ratios, we can kind of see, how is gold on a relative basis as far as valuation going back, an extended period of time. And eventually my final target for this bull is 2237, but I'll kind of get into why I say that number. The only things that didn't happen was the DXY consolidation would take 37 months. Turns out, remember in part 1 and part 2, I thought it was actually going to be a faster cycle. Then back in May, it didn't seem like it was going to be able to catch up in time. It looked like it was going to stall out, but sure enough, it actually is faster than the original 37-month target that I said last time. So it actually ended up going down to its key trend line further and faster than initially expected. And then the Great British Pound would fail the orange trend line support, which it has not done yet. It actually ended up holding that for now. So as of right now, the pound is not signaling we're going to parity just yet.
Okay.
But I kind of wanted to go over kind of a general, where are we now? Obviously, the last 2 months, a lot has changed. I mean, there's still 40 million plus without jobs. Many of them are being structurally moved into structural unemployment because they're being, out of the labor market for longer than a 6-month period. We have federal stimulus that obviously softened the initial blow from COVID and all the other shutdowns. But, many of these policies were kind of kicking the can down the road. And so as of right now, a lot of people are not necessarily feeling the pain, but, some of these, unemployment insurance, which was $600, is being dropped now to $400. And evictions have been deferred, so that's kind of putting off any kind of REIT Armageddon in the real estate sector. So there's obviously a lot of potential still catalysts that could cause more downside, but as of right now, we're kind of weathering through the storm, and that's kind of where we are as far as a global economy. And then obviously continued stimulus is putting additional pressure on currencies as governments try to act and support their economies. So initially we'll go through some of the Forex updates of what's happened over the past 2 months. Here is the euro dollar chart that we've discussed many times before. Back last time when I was on, euro dollar was right around the kind of 108 level. It was holding this kind of key flat bottom Bollinger support that I said was kind of a brick wall of support. And I said that it would more than likely go up to the 50-day moving average, or if not exceed it. At that time, my blue line was actually off a little bit, so I readjusted it to actually connect to all the dots, all the previous peaks. And it comes out to about a 117 handle. It obviously overshot that a little bit, but then now it's obviously come and hit the 200 monthly moving average. on the euro dollar, and so far it's rejected. As of right now, it's actually above that upper Bollinger, which is actually a very rare phenomenon. You only see that a few times over the past.
What's the implications of that being
So
above?
I'll show you actually right now. So here's one in early 2018. It exceeded the upper Bollinger and then it pulled back. Here was another one in 17. So short term, typically it implies some sort of a consolidation. The last time it specifically rejected the 200 above the upper Bollinger, it then pulled back to the 50-day. So whether or not we're going to get that large of a move or not, remains to be seen. But the only other examples are all the way back here in 08. There's also another overshoot, and then it had a higher peak, and then it kind of started to consolidate.
So
But
you use these a lot, Mystery. And, I remember seeing Bollinger talk about when the bands compress,
correct.
that the first move out of these bands is a breakout fake out. And then the next time back within the bands is a real move. Have you noticed that too?
That is, in many ways, it's kind of like there's like elasticity with the bands. When you overshoot it, it wants to come pull back, and then either start the next leg, or oftentimes you can actually have some sort of the initial move might actually just be a head fake to the upside before.
That's what I mean.
Reversal downside shock. So
Yeah.
it depends. A lot of it depends on the setup.
Okay.
The thing about, and the reason I've called this the global forex parity thesis is technically right now it's still a hypothesis, because until this holds, until this, right? I mean, we're literally, it's 15 months later since we first discussed it. That's how long
Right.
it's taken us just to get back here to test it, to verify that this is in fact going to happen. So ironically enough, the theory is literally being put to the test over the next, 30 days. 30 to 60 days. We'll know if this in fact is the move to parity or not. Now, if
Okay.
this completely, pulls back and then just blows out here all the way up to the 120s, then no, then I'll be the first one to admit it's not going to happen. But
Okay. Yeah. So
if
we're at that important inflection point.
this is literally the most important inflection point in the past probably 5-10 years. I mean, it really is that important. Now, what happens here will depend largely on kind of what I'll break down in the next slides. But just know that we are at a very key important inflection point, and that this will determine whether or not the theory will either come true or be completely nullified. So thus far, I mean, the entire cycle has been pretty repetitive. I mean, it's been predictable. You kind of tell where it was going. Now the bigger question comes in, where does, on the relative basis, where does Eurozone and the US kind of differ in their policies? This kind of gets into physical stimulus. I mean, we're really kind of getting into the weeds as far as macroeconomics and how it's going to impact the currencies based on
Okay.
how much money they're printing.
When you use major trend lines like this,
Mm-hmm.
do you need more than one close above it to feel confident that the trend has broken?
Normally, I agree. I think in this specific case, because I'm actually lining up all the actual inter-month peaks,
Yeah.
not necessarily, but if you're
Okay.
using the bodies of the actual, the upper close of the candle, if that's what you're using as, then yes, overshoots can happen. But I like to use the absolute peaks, so it just kind of lines up better.
Okay.
So, I mean, obviously down here is still the parity window. It's obviously still open. So the real question is, are we going to have some sort of setup like in 12 to 14 where, we had that touch, albeit it happens sooner than expected. And then are we going to have some sort of reversal here? And I'll kind of break down the mathematics of, if we do, what are the exact dates we'll see some sort of confirmation.
Okay. Yeah, we're
Here,
right at that test. Okay.
yeah, here's the pound dollar. Initially, last time we were here, and I said if this magenta line held, then it would be a repeat of this pattern. Thus far, it has not broken that support, that key support around 120. Sorry, I apologize. And if you look here, the MACD is kind of confirming a similar kind of horizontal stalling pattern as it did here during this period, where it did not break down, but it kept rejecting at the 50-day moving average. So, we rejected once here at the 50-day and then it fell off. 50 monthly moving average, and then here again. And every time it did it previously, it would pull back to the 13-day moving average almost without exception. There's 1, 2, 3, 4, 5 examples, and every single time the next candle hit the 13. Well, the 13 on this candle is down at 127.80. So, previously it was 5 for 5. Whether or not it will happen again, in theory, it can. This time in 2018, it did not, but I think just because the gap was so large. But so far, this 50 monthly moving average has been kind of a brick wall of resistance, and these patterns are kind of similarly forming. So you could deduce from this that as of right now, the pound is not ready to make the next move down. For now, it's still kind of in a consolidation holding pattern. Whether or not it will break out above the 50 or not, like it did here in 14, we'll find out here pretty soon. But if it holds here, then the next path should be back down towards kind of the base of this channel in the low 120s. And then on the other key premise of the thesis was that pound would have to relatively underperform euro in order to get to parity, just because it's starting from a much higher base. Well, last time I came on in May, we were actually right here in this large red candle. It was in the middle of this monthly candle. And even though both euro and pound have increased relative to the dollar, pound is still underperforming euro.
Yes.
On a relative basis. And so
Yes.
this is still holding true. And right now we're literally resting on this orange key trend line. And if you look, if the MACD back in 07, we had a similar pattern where it kind of stalled up into, or kind of had a slow drift up into the center line, and then it formed a bearish reversal, and then it rolled over. Well, we just formed a bear cross here, so it is doing that. And now, in order to confirm, we would need the MACD to kind of roll over. If it does, that indicates that the pound is going to make a break lower. And if it does, then it will start a similar flushing pattern sitting here back in 07, 08, 09.
So in FX terms, you would favor long euro, short pound.
Yes, if you're between those two, absolutely. Or if you're, in a dollar, if dollar is your main currency, you could then perhaps be net short pound over euro. So it depends on how you want to trade it. But
Okay.
I think in theory, pound should be the more bearish bet of the two if you're having to choose. But I mean, obviously you can play both if you want. But that's how I would, if I had to put my, so to speak, bet on it, that's what I would bet. Is that, in my opinion, I think I'm actually short both right now, but I think pound will have a more room to fall, and oftentimes when it does, the flushes are usually harsher and harder and faster. So to me, that's the way I would go. But I mean, if you want to do euro, you can do that too. But this is more just to show on a relative basis. This one pair has to confirm to the downside in order for parity, global parity, to happen at the same time, because the currency is more valuable on a relative basis. So that's basically the whole point of this chart. And I know you like to do the inverse of this chart, but for me, in order to line up with my thesis, it's just more convenient this way.
Okay.
And so this is actually the kind of the bread and butter of the whole global parity thesis. Is that initially, what we had expected was that when I was on last time, it's this tall red shooting star. That's crazy that seems like forever ago, but it was just a few months ago. And I said that from there we were going to flush down to below the 50-day moving average, and I thought it was going to kind of stall out here just below the 50 and then trend sideways. Well, it turns out, and if that had happened, it would push off touching the purple base trend line until March 2021. That actually ended up being wrong. It actually ended up being significantly faster. And ironically enough, in theory, it may not seem like it now, but it's actually more bullish for the dollar that it happened sooner, because what it did is essentially pulled forward that consolidation, which is now forming at this, at the key purple 10-year trend line. Now, you also notice here that it's exceeded the lower Bollinger significantly, and it's only done that on the DXY one other time, which is back here in 2018, and then it formed a solid base here.
Where would it get back inside the Bollinger Band? where is that last band that's touching the top of this little white candle that's beginning to form?
That's at about it's a let's see, 90. It's just, yeah, it's like 93.50. Sorry, 93.90 something. It's, I mean, it's basically 94.
Okay.
So, and in this pattern,
So
it kind of
just like the euro, it's the inverse, good or bad.
Correct. Exactly. Yes. I mean, because the euro is 57.6% of the DXY,
Right.
naturally they're going to be highly inverse correlation. Now, what's interesting, and I'll kind of touch on this a little bit, is there's a bottoming pattern sequence that happens every time it kind of has reached the bottom, and I'll kind of break it down mathematically. I don't want to reveal it yet, but that kind of gives us a counting, kind of like a countdown clock as to if this is to play out. And remember, this purple trend line has to hold in order for the thesis to prove true. If this completely blows out when we flush to 88, then no. I mean, you can toss all this into the garbage can. Okay. So this really is putting both the theory and a lot of major macro forces to test right now. Obviously, you know, Fed printing $2 trillion, that's what accelerated this flush even faster than anticipated, which is because they're printing so much money. And obviously now with President Trump signing the executive order, you know, they're, you know, flooding it even more into the system. So let's see. And then, so for now, the key takeaway is that this 37-month stalling pattern is not happening because price action here did not flush. It just held at the 50, kind of as a mean reversion, and went sideways, whereas we went straight down to the purple trend line. So it has to hold here, but if it does, this should be a solid base for a very strong impulse upward over the next 2.5 months.
Okay.
And so we'll kind of break down. I wanted to go over bonds a little bit and kind of tie it into, you know, the currency as well. Last time when I was on was here in May, and I said there was going to be another drop in yields, but that we were getting extremely close to par value on U.S. Treasuries, which is $1,000 on the bond. So sure enough, we had another rollover, and you know, we started to drift lower. But you know, this is kind of comparing the two different patterns. You're starting to realize we're basically running to the law of diminishing returns at this point. I mean, you're trying to squeeze blood out of a diamond because there's just not much room left till zero bound. So you know, if we start to see some kind of a consolidation here, you could see some sort of a double bottom, or if we do, it may just slightly lower. But I last time we discussed, you know, negative interest rates. I don't think we're going to go there. I don't think the Fed wants to go there. So if you believe
I think they're turning, Mystery. What do you think a 120 yield would do? Would that be part of the dollar rally? If yields rallied, you know, I'm talking about 70 bips, 60 bips.
Oh, you're talking all the way up to like up here up to the
120.
Then once you start to see, after any major yield flush, once you start to see yields kind of pop off bottom, what that's starting to signify is that inflation is now finally starting to creep back into the system. I mean, you're basically liquefied the system and you're pumping money. At that point, you know, that would actually send a lot of different signals to both potential U.S. equities, gold, and other commodities as well. It depends on why it's going to pop off zero. For now, we discussed last time, and you actually brought it up, which was a great point, that because the Fed is propping up bonds, treasury bonds, and buying them, what's it's artificially doing is suppressing, keeping the yields down. So because they're stepping in, I don't know if it can break above this kind of, you know, 80 basis points level. I think it may kind of stop and hold here, and they're going to intentionally keep liquefying the system until they feel like, you know, bond pressures have subsided. I could be wrong. Maybe they'll let it pop. But for now, I think they don't want to send any kind of harsh signals to the market. So I think for now they're stepping in, but you know, there's just only so much more you can squeeze this. I mean, we're already down at what, 50, and it kind of, and you can see it hit this flat lower Bollinger Bands, which I've always said is kind of like a brick wall of support, kind of like Euro did, you know, a couple months ago. Anytime you see these kind of flat lower Bollingers, it's really hard to kind of push it any lower. I mean, you're really pushing against a brick wall. So this could potentially be a double bottom in yields. So just be aware of that. MACD is also supporting that. I think it's had enough. I mean, it's reached decade lows, and then now it's finally starting to try and build a base and rally back up. So we'll see. I mean, it's to be determined, or yet to be determined. But for
I
now,
think these are even more than decade lows. I think they're century lows.
well,
I've heard
the
a
actual
comment that rates have not been this low since the American Civil War.
on a real net basis, yes, you're correct. What I meant is the MACD is at is a
Oh,
decade low,
oh,
but
okay.
the actual yields is an all-time low. They've never.
Yeah.
I mean, as far as nominally 2s, 5s, 10s, I mean, we've never been this low. So I mean, even going, I mean, in 08, we were nowhere near these levels.
Right.
So this is,
Right.
and I said last time, a lot of this is partly because the rest of the world, many of the sovereign debt is obviously negative yielding. So that artificially pushed our curve down even further on the long end, because basically everyone's just flushing into ours in order to get some sort of a yield. So that's also why this drop down here was so extreme. It's just basically everyone piled in. But right now, even with everyone continuing to pile in, there's really not much more room to go. We're kind of at that law of diminishing
Yeah,
returns.
people were financing their log cabins at 0.5% back then.
I know, basically, yeah. I mean, if you can find if you can find one, yes. If you can find
Yeah.
one, you're refinancing. But
All right.
okay, and so then we're kind of go. So last time when I came on, at the time, gold was about 1720, 1730, the day I came on, and when I said 2100 by 2021, it sounded like a crazy call. It sounded extreme, but what I'm about to show you will show why it actually was not that extreme, and actually it's part of a much broader macro bull market. So when I came on last time, we were still underneath this purple horizontal resistance line, kind of right around here.
Yeah.
And this actually, the upper blue line connects the 2011 peak all the way back to the 1970 peak. So this is a 40 plus year formation. And for those that want to see the full chart, I have it on Charts Coach. But naturally, I knew that this is there's basically a magnet up here pulling price action towards it. And once we get there, that's when we could see some sort of a potential consolidation. But in the meantime, even when we were here and here, everyone's saying gold's going to crash, gold's going to crash, gold's going to crash. I don't know what they were looking at, but everyone said it was going to crash, and I was like, I have not seen a more bullish chart, in a decade. So even the MACDs are starting to confirm, this is a full-on bull market similar to the one we had in 09 to 11, and that peaked at 150, and the MACD is still at 126 right now. So it's showing we still have a little bit more room to go. The RSI is also approaching multi-decade high levels. And right now, currently, in May, I was on Charts Coach. I was pounding the table, telling my members, just buy shares. Don't worry. Don't listen to any negative. Like this is a major, massive macro bull. Plus, never has the fundamentals for gold been so strong because they're printing trillions of dollars, which is we've never done before. So when you're monetizing this much debt, real net interest rates are already negative, even though if they're not nominally, on a real basis they already are. So it's basically a rocket ship for precious metals.
Would the picture change for you if we started trading underneath 1800? Because I think we could pull back there, but I'm wondering if if that's a
today
breakout.
it's already down $65 today alone. I don't know if you checked the gold chart today, but it's down big today. And I had said in May, in June is going to be a consolidation month, July is going to rocket, and then August will be another consolidation month because we've just overshot the upper Bollinger on the monthly chart so much. I mean, we really shot out. So anytime you have this sort of price action needs to consolidate a little bit. And that's initially why I gave the 2021 instead of saying end of this year, because I knew there was going to be one last sort of consolidation to kind of cool off before we make that final bullish impulse. But this kind of shows you how when you kind of take a step back and look at the monthly charts and not look at the kind of the daily noise, it provides a lot of clarity as far as what the major formation we're in.
Love telescopes, bro.
Yeah, they're awesome. But this so it's obviously off the charts, so you can't just, it'd be nice if you could just do it. But based on my calculations, I'm showing 2237 as a possible final peak. It may get all the way up to 2250, give or take $10 or $20. I mean, at this point, it's splitting hairs. But that's my final target of where this blue trend line will go. Now, previously, I thought, March 2021 was going to be where we touched down on the DXY, and that was going to give us a lot of more time in this bull. But now that it's potentially being moved forward, this may actually be an interim peak, similar to here, if this trend line chooses to hold. Now, the percentage move of the 70s gold bull and the 05 to 11 bull, those are between 650 and 750%. This one is actually only about 150%. So it's a much smaller move. I don't know if that means that blue line is going to get taken out, it's going to rocket higher, or in fact, because there's two prior peaks, now we actually have a trend line. And before in 11, there wasn't a trend line. It was basically, there was no basis to know where it would stop. But now that we have these two, usually these macro multi-decade trend lines, they're pretty tough brick walls. I mean, so we'll find that here pretty soon. But that kind of does tie into if the DXY is going to bottom in my target window of between October 2nd and October 30th. That would make sense why we would, kind of peak here, because then the dollar would, start to rocket higher, and then I would obviously provide some sort of a headwind. Now, I don't think gold's going to crash per se, because there's still a strong fundamental backdrop, but it will definitely face some headwinds, some downward pressure. But up until that point, I still see gold, after this month is over, and in September, October, it should have one last kind of hurrah in order to make it up there. And then I want to do also kind of like last time, kind of touched on how, I believe that U.S. Treasury, the reason we were going to get to 2100 was that a lot of physical demand for treasuries would actually start to overflow or spill into the gold market. And sure enough, that actually started happening. Now, I showed this chart last time, which is the gold TLT ratio, which is the 20-year, 20-plus year Treasury ETF. And when I came on last time, we were actually at about 10.5, which is right here. Yep. And sure enough, we've actually broken out above the channel. Now it's above 12 to 1. But on a relative basis, when you look at, where it was in 2011, it was all the way up at 22 to 1. So net long term, if we're talking, 3-5 years, if you want to talk about the real macro bull on gold, I'm not just talking about this short move that we're experiencing now, but I mean, you're talking out a decade or two. This implies that there is still a lot of upside on gold.
This is just beginning.
Yeah, this is, and this channel has been so tight it's been almost in lockstep on a 1-to-1 ratio since 2015. And relative to bonds, now once treasuries hit their par value, that's by definition when this is going to start to really rocket higher, because as we said last time, once bonds hit that that ceiling, that invisible ceiling, then this ratio will really start to accelerate. And that's what you start to notice. Once we start hitting that lower bound on the 10-year, that's when this chart started to break out. And now notice, interestingly, the last time the DXY had a major bottom was Q1, Q2 of 2018, and it also broke out. So is it possible this is a false breakout? It's possible. But it also does coincide with that being a major kind of dollar bottom as well.
Interesting.
And then this is the other chart that we discussed. And last time when I was on, this is the gold DXY ratio. So this is actually against the entire US dollar basket, not just specifically the dollar, but the entire basket of currencies. And I said, I don't remember if last time I had that, that picture of the Milky Way galaxy and the solar system, and how everything was actually, all the currencies were actually rotating around gold, but gold itself was elevating its value across all currencies. And last time it came on was the purple arrow. We were at about 18 to 1, and just in 2 months alone, we've already rocketed up to 22 to 1. So this also shows the previous peak being around 26. 26 to 1. We're actually getting pretty close to there, which it kind of ties into us being close to that upper blue trend line on the monthly chart. And if we, stay at 26 and DXY's, in the low 90s, it also is roughly, 22, 2300. It actually is a little bit higher. It's 23 and change. So all these are kind of pointing to, a target, a final target on gold for this specific bull above 2200. Some of them are even more significantly. If you did 94 times 26, DXY 94 times 26, that's 2444. So you're kind of in that 22 to 23, 2400 range for a lot of these. I don't think we're going to get all the way to 2400. I don't know if we have enough time left, but at least on the short term. Before DXY, if it does in fact bottom. Now, if DXY implodes, this ratio could blow out to 30, and that's a completely different scenario, obviously. The MACD here, though, does show that it still has plenty of room. I mean, last time we were all the way up at 2, and now we're only at a 130 on the MACD. So we still have room to run. But it's interesting to see how smooth of an arc this is, and how much bullish pressure. As I don't even remember in 2011 if I was going on watching CNBC or Bloomberg and having every fund manager pumping gold. I mean, I never thought in a million years that every macro fund would be bullish gold, and be it would be almost acceptable and then you wouldn't be a crackpot investing in gold. But now it's actually a hot thing, which is actually kind of concerning from a bull standpoint. Maybe the trade is going to get here a little bit too crowded. But for now, the trend is still intact. And this previous peak shows we still have a little bit of room to run, at least in the short term.
Okay.
And then last time, we kind of did a gold Bitcoin comparison. Well, I also want to start doing a treasury to gold comparison as a market cap comparison. And for many that may not be aware, total physical treasuries as of earlier this year, obviously now it's changing by the minute, but as of middle of this year, I think roughly it was May, there's roughly 18 trillion outstanding in actual US Treasury bonds. And when we first started this, gold was at 7.07 trillion as of May of last year, 2019. And in that short period alone, we've gone from 707 up to 1285 or 12.85 trillion on gold for a total market cap, global market cap or market valuation. So even in this 1 year alone, the Treasury to gold market cap multiple dropped from 2.6 all the way down to 1.4. And for those that are curious, well, what would happen to the price of gold in order to equal the value of US Treasuries, assuming they don't print more? It would actually be 29.37. So you're starting to see, once you start using a lot of these kind of metrics or ratios, you can kind of get a feel for gold does still have a lot to the upside from in the long-term standpoint. I don't think we're anywhere near the ultimate top in gold. I'm talking, 10, 15, 20 years out. But in the short term, technical trend lines are different. Obviously they have a factor, but
I never would have guessed it was that close.
Yeah, and I didn't. And to be honest, I was curious, and I knew there was obviously our total national debt's 25 trillion, but not all of it's held in actual physical treasury bonds. Obviously, they have other instruments. So
I was talking about gold being as close to the total number of bonds out there.
Correct. I mean, and
because everyone talks about it being it doesn't take much money to move it. It's, the market cap, maybe they're talking about miners, all right, like the market cap of miners.
That's different. I mean, that's obviously a much larger number, but as far as, this is just physical bullion. I mean, gold bars.
Right.
So, and obviously treasury is mostly held by institutional sovereign wealth funds, central banks. And of course, gold is pretty much almost, staggering majority, almost 90% is in central banks somewhere.
Can you think of any scenario, Mystery, where central banks might liquidate gold?
So here's the thing, and I know Peter Schiff's been pounding the table for like 20 years, but I have to give him credit. He finally was right on a lot of things, and he did make one good point that I liked. that I always kind of thought of is that there's no such thing as too little gold. You simply have to allow gold to naturally appreciate to its true fair market value in order to then balance out the global debt. The reason there's so much global debt is because gold is actually not allowed to appreciate to its normal value. If gold were appreciate to what many have argued is the quote unquote true value in order to balance out the global debt, it'd be above 50,000 an ounce. And at that point, there would actually be no debt. But I don't see it going there, so please don't quote me on that. I'm just making a point that that's where you could see a scenario where central banks could liquefy. I mean, if we get some sort of crazy move to the upside, maybe 5, 10,000, 15,000 an ounce. I know it sounds crazy now, but I mean, ironically enough, I think Bitcoin kind of turned the light bulb on. And people are saying, wait a minute, if Bitcoin can get there, why can't gold? So I think you're starting to see a lot of this kind of creep into the gold market. But it's interesting that 1.4 times, that's not that far. I mean, there's we talk about global forex parity. Well, we could have treasury gold parity here pretty soon. So that's a whole nother, and treasury bonds are obviously the number one store of liquidity globally. So it's kind of, when you think about it, if gold were to even surpass that, that's really, you're kind of getting into unknown territory, because not even in on a relative basis in 2011 or even in the 1970s was this the case. So kind of interesting times, sign of the times that we're where gold is really starting to make a case here for itself.
Okay.
And then also I want to go over gold, Bitcoin.
There you go, Jane.
Yeah. So I know everyone always loves this. They always quote this one. So this again is I've kind of touched on this the last few presentations because people like it. It's good to kind of monitor and see where gold is relative to Bitcoin, and to kind of give a frame of reference. And a lot of people use a lot of hyperbole and a lot of hype and buzz, but when you actually look at the actual numbers, so just from last meeting in May, which is May 26th, Bitcoin actually had a decent move. It had a move to the upside, which I'll cover here, and it actually broke out from my key macro trend line. And I said if it did that, then there was chance to at least potentially revisit the all-time highs again at some point. So it did break out, and on a percentage basis, it did break out even more than gold. But let's temper our enthusiasm a little bit, because that big jump in price or on a percentage basis really only netted in a increase in 57 billion in total market cap. So it went from about 161 up to 218 billion. So many will say, oh, well, the ratio went down from 66 all the way to 58, from stratospheric to just nosebleed. But I mean, when you look at the actual nominal dollar value of market cap appreciation, I mean, gold went from 10.6 trillion to 12.8 trillion. So I mean, it's like an early Mike Tyson fight. It's not even close. It's a knockout, first round knockout. So it's kind of important to see when you take a step back and take a look at it and see, okay, well, how?
Well, trillion's a new billion, because billion doesn't mean as much anymore. So
it really is. Yeah, it's kind of
like, billion's like
no, it's like a million.
It's passe. Everything has to be done in trillions now, partner.
I know. So anyways, it's just kind of cool to see the comparison and just get but it's still 58 times, which is obviously a massive amount. Now, I know some people are saying Bitcoin's going to go to a million or whatever crazy number, but I don't know. I'm still skeptical. Maybe I'm wrong. You can call me on it. That's fine. But to me, I still believe that the central banks have every incentive to use gold as a weapon against Bitcoin and not the other way around. And on a nominal basis, the price it would have to get to even remotely resemble gold, it's pretty obscene. Can it? Maybe
50,000
over, yeah, easily. Well, no, you're talking hundreds of thousands.
Okay, all right.
So it's kind of, it's getting into tinfoil hat territory.
Okay.
So this was actually the Bitcoin chart I brought up last time. We had this long-term purple descending trend line, resistance trend line, going back all the way to the peak from late 2017. And for a while there, it was looking like maybe it was actually going to hold, but then I think gold kind of racing out the gate kind of helped pull, ironically, pull Bitcoin with it. So we got a big breakout. As of right now, it's still respecting the upper Bollinger. It's not really blasting higher, so maybe perhaps there may be a consolidation. It's also important to note that this kind of 12,000 level was also 1, 2, 3, 4, about 5 on a closing basis, held 5 different times before. So this is actually a major kind of horizontal resistance as well too, which I don't have drawn, but you can clearly see it's right there. So we'll see. I mean, at least it broke out of the purple trend line, so bulls can be happy about that. Whether or not we need to consolidate back to the 13, that'll kind of reveal a little bit more. But for now, it's actually doing pretty good. So this kind of all ties in. Gold is kind of continuing to reassert itself into the global monetary order. In the process, gold will be a key player in a post-singular currency world. And the ultimate goal is having a bipolar wealth world. We have STRs and, like I discussed last time, and gold. And then how does all this tie in together? Well, we brought up I brought this chart up last time, which is actually my favorite chart. And this, I hypothesized last time that gold had officially broken the DXY inverse relationship that it held for the longest time. And we said that in theory, this chart should not make any sense. If, dollar was a constant, how can it go from an previous all-time high of 1920 when the DXY was at 72 all the way down to 1050 when the DXY hit 100 previously in 15 and 16, and then that drop from 100 down to 89 popped gold from 1050 all the way up to a stratospheric 1360, and for a long time that held as the interim term high. Well, what happened? Well, DXY went up from 89 to 101, but gold went up, which makes absolutely no sense. Yeah. And this kind of starting to tie into what the analogy I used last time of the Milky Way galaxy. Because this is against a basket of currencies, gold is now appreciating across all currencies, and that's what you're seeing here. So people say, oh, well, if you think dollars DXY is going to go to 109, does that mean gold is going to crash? Well, up until May of this year, no. I would have said yes, that probably would happen. But now that it's completely broken the relationship, we can't really use that anymore, because clearly, going from 89 to 101, you add roughly almost $400 to gold price, and then going from 101 back down to 93. When this previous time, when it went from 100 down to 89, it was only a 200 point move, roughly. Sorry, roughly 300 point move. Sorry.
Okay.
Whereas this one, the same 100 down to a much higher level was almost a 400 point move or a $370 move. So you're starting to see how even if we go, much higher up to, I think the ultimate target on this is 109, that doesn't necessarily mean gold has to crash to an obscene number. And for the longest time, I thought it would, because this relationship had held. I mean, remember when we spoke back in last May, I thought because it was holding at the time that gold would drop below 1,000. But once it broke down from 1360, I backed off that, and I realized that just wasn't correct anymore, because it wasn't lining up. As the dollar was rising, gold wasn't being impacted anymore. And I think a lot of that is, the U.S. Treasury demand that we've been talking about. Is you're seeing so much money piling in from other aspects that I think the U.S. Treasury gold relationship is actually more important than the inverse DXY relationship, because now it's clearly being broken. But if you look clearly, the MACD and stochastics patterns are almost identical to this consolidation period. It dropped below the center line. Even the kind of descending orange bear channel is forming, and we are approaching, if you see right here, a very extreme low, very similar to October of 14, which is when the dollar bottomed last time, the big dollar bottom.
Nice presentation, Mystery.
Thank you. I appreciate it. And so it's kind of the reason I keep bringing this up is, there's an old saying, correlations work until they don't. And I know for the longest time, people get kind of marred, almost dogmatic, and being so extreme as, oh, well, if this does A does this, then B must do that. And it's sometimes as traders, we need to kind of back off those absolutes, because a lot of times there's external factors that can skew the market one way or the other that will no longer make that relationship work in a predictable pattern or a predictable habit. So that's ultimately what this chart is showing, is that yes, I do believe DXY is going up, but that does not necessarily mean gold is going to crash $1,000 or 1,000 points. It's
the next relationship that'll probably be part of your next visit here will be to see if the correlation of higher yields, because I think it'll happen by the time we talk.
Sure.
I'm not saying permanently up, but
Yeah.
some type of squeeze in
Sure.
yields and then back down, to see if that traditional correlation works, which should mean should put pressure on prices, because gold really rallied because we had negative real yields.
Correct.
So if yields
No,
start to head
that'll
up,
be
we'll
my
see.
that'll be my homework assignment for next time.
Yeah, yeah. So I think yields will become part of the discussion with the dollar and everything. Alex, be interesting to see if we break away.
I definitely believe that. My only concern about having any sort of significant yield pop is that during the
Fed.
08, 09 recession, they kept them artificially low for a long period of time. And so right now, I even tell my Charge Coast members, like, you can't. First of all, bonds are almost impossible to trade right now. The premiums are absurd, and it's really hard to make money doing it right now, which is not like 2019, where it was the most profitable asset class to
TLT
trade.
used to be very
Oh my
liquid.
God, it was, not only that, but you could go $3 out the money for pennies and just have monster trades. Now you got to go $8 to $10 out the money for the same contract price. So the market makers, they gutted that market, which it was overcrowded and needed to be
Fed
done.
did.
That too, yeah. But that's why I although everyone's saying pop yields, I've been telling over on my platform, do not try and short it yet. It's not a viable trade yet. Just you can use it as a macroeconomic indicator, but right now you just can't touch it, because basically the Fed's jumping in, and it's now an artificially suppressed market. So
yeah, it is.
Or artificially keeping it up or depressing yields.
And you're not, you know what? You're not artificial. You're authentic. And you give us your real ideas and thoughtful insights about the big picture. Really appreciate it, Alex. And
of course,
and
then I wanted to touch base.
Go ahead.
Yeah. So the reason why I wanted to bring this up is, if you look at every key bottom, I look back at every major dollar bottom along this bull channel, and I counted how many weeks did it take before, from initial touch to quote unquote ideal entry, before some sort of major breakout happened, which would be inverse on the euro, or a peak on a euro.
Right.
And I found something interesting. So the two extremes were 9 weeks and 17 weeks. And if we assume a normalized distribution or bell curve, that would put the mean or median at around roughly 12 to 13 weeks. Well, the two middle examples of the four, sample size 4, was also 12 and 13 weeks. So if we assume that using that as a kind of I know it's only 4 sample set, but assuming we use that as a sample set, I believe that sometime within the 9 to 13 weeks, we will have some sort of a geopolitical or some kind of shock to the system that's going to make the DXY pop off the bottom trend line. The reason why I cut out 17 is because 17 happened all the way back in the early 2000s, and sorry, the aughts, or what do you want to call them, and that. And ever since then, it's actually been a decreasing pattern. So it was 17, then 12, and 13, and then 9. So it's been in a decreasing pattern. So to me, I'm more on the left tail side of this curve. That would put us between 9 and 13 weeks. Well, if you do 9 to 13 weeks from the initial touch at the end of July, that puts us roughly between October 2nd, October 30th. So if it's October 2nd, October 30th, something big is going to happen. enough to cause some sort of major shock, assuming this trend line holds and assuming I'm not completely wrong and assuming none of this is just purely theoretical, what could possibly cause that to happen? And so then I thought, okay, well, what are possible catalysts? And maybe Biden starts leading seriously in the polls. Maybe there will be an administration change and that'll cause some sort of shock to equity markets and cause them to weaken. Maybe there's another possible virus wave. Maybe things get a lot worse. Could it be like number 4, number 5, like some sort of Italy exit or Grexit or
I know a guy looking for number 4.
number 4? And
Yeah.
I don't think
Italy.
it's exclusively number 5 because the pound is only 13.1% of the DXY. It's not enough to cause that kind of an outsized move. So maybe 4 and 5 is a package deal. They may not be mutually exclusive.
Okay.
Maybe Brexit, some sort of escalation causes more sovereign debt fears, and Italy and Greece kind of come into it. Or there's always, the potential unknown black swan. We never saw COVID coming, and that happened. So these are kind of the possible catalysts that I see potentially causing that shock. And then, essentially, like as a conclusion, global forex parity will potentially, it's potentially entering its final phase. Initially from part 1, the parity window was between April 2019 and March 2025. The median or mean of that is March 2022. This time, the consolidation period, I believe, is now accelerated. It's not going to stall out to March. We're actually in it now. And so if that 9 to 13 week clock countdown starts, it's going to be somewhere between October 2nd and October 30th, which actually was the biggest problem I had with part 3. I couldn't reconcile why it would stall to March if I believe there's going to be some sort of a downturn in the economy before the election. Again, that's just a hypothesis. Things may rally into the election, but if the global elite really want to get Trump out, they're going to have to. Something ugly is going to happen. Some bombshell, whether it be a scandal or whatever it may be. I don't know. This would be your window, October 2nd to October 30th, where you would start to see that happen. And then obviously gold is still cheap on a historical basis, and ultimately we'd be in a 2-tier system. So that's kind of the gist of what I wanted to present today. And I don't know if you had any questions as far as your users or if they had any comments.
No, go ahead, do your commercial.
Okay. This is obviously my charts coach. Over the last month, I've added like 30 different new features. I mean, it's turned into a really robust platform. It's funny, I started the platform to be for like, educational and beginners, but to be honest, 60 to 70% of my members are actually fund managers, believe it or not. So it's mostly professionals on the platform, which is kind of cool. But and then I have exciting news that I'm actually going to be doing a private podcast on the platform, a weekly kind of update between our chats, because everybody loves our chat so much, but everyone's always like, well, can you do more in between them? So I kind of decided to fill the gap based on a lot of requests. So if you ever want to, hear from me in between our great interviews, that's always a possibility. And so that'll be coming up hopefully here in the next
What's
month.
the website address?
Yeah, here you go. So
Okay.
it's chartscoach.com, and on Twitter, it's at MysteryTrader99. If you'll have any questions, feel free to reach out. But I really wanted to thank you, Dale, for always being gracious and inviting me on and kind of sharing my thesis. And we'll find out. Maybe in the next 30 days, I'm completely wrong. I'll be the first to admit it. But, if it starts to hold here, we need to take a lot of this data into context and see, use it to benefit.
I had a manager when I was a commodity broker who said, you can't drive a taxi cab without getting tickets. So you can't be an analyst without being wrong.
Of course, and I fully acknowledge that.
So, I mean, that's part of it.
Yeah, I mean, the goal is to be at least 80%. You do that, you're doing pretty good.
Yeah, and thank you so much for your presentation today, Alex. I hope you and your family remain untouched from COVID. Any final thoughts on COVID?
Right now we're kind of in I don't know if it's a cognitive dissonance or kind of a lull. I mean, things are still ugly in many parts of the country, but it's not having it's causing 2 different economies. There's the financial market economy, which is screaming to all-time highs, and the Main Street economy where everyone's angry and frustrated, like, what's going on? Life sucks, and yet I'm seeing the stock market rally every day. That causes a lot of dystopian kind of people are upset, and that's why you're seeing these riots. You're seeing it's just a lot of general frustration, and I think it's unfortunate, but that's what happens when ironically enough, Federal Reserve liquidity injections actually causes more economic disparity and a much bigger gap between the different classes than had they just allowed the system to kind of correct. But they have their political motives and whatnot. So
Yeah.
I hope to God there's not a second wave. But if 1918 is an example, and also
Yeah.
I'm here in Texas and we're a hot spot, and it's I have my family members fighting on the front line, so I get private data that nobody else sees. And there's still, it's hovering between 19.5 to 22% constantly testing positive.
Wow.
So
Yeah.
it's
Yeah.
still a thing.
It's a
So, but
mess.
I hope, hopefully we get through it, but I hope people take it seriously. But if not, there'll probably be a resurgence in the fall, unfortunately. So,
Okay, buddy. All right.
we
Well,
just stay safe, Dale. Thank you so much, and
all right,
hope
bro.
the whole team stays safe and have a good one.
All right, and we'll schedule something for like November. How's that?
Perfect.
Right around when the cycles are completing.
That sounds perfect. I'm looking
Okay,
forward to
buddy.
it. Thanks, Dale. Appreciate it.
You're
Have a good
welcome.
one.
All right,
God bless.
everyone. That's a wrap for Turnaround Tuesday. Remember, don't just count your pips, count your blessings. You could find Alex at Mystery Trader 99 or Trading Coach, and that's a wrap. Good hunting the rest of the day, everyone. You're welcome. You're very welcome. You're welcome. Adios.